We have Santosh Kumar Singh joining us now to talk about specific areas of the market and how are things looking. Santosh, good afternoon. Let me start by when we had you on the channel last, a couple of months back, if I'm not wrong, the conversation had ended on the note that after banks, now the NBFCs could be an area where market could start focusing on low valuations. And NBFCs have actually started doing very well, especially the housing NBFCs. What does the credit growth outlook look like of that space?
See, on an overall basis, this year might, the system might grow at 16-17%, the overall system. The question will always be around next year how the system will do. And within that, housing finance, in my view, whether it's this year or next year, it's going, so it's not going to sort of go down. So my worry is that on a systemic level, the growth in the next year, that is the financial year 23-24, might be lower than what we saw in FY 22-23, but that might not happen in housing finance. And the second part of the equation is around net interest margins. So if you are an NBFC, this year was a problematic year because you were the higher interest rates were getting passed on to you, and you had a lag on passing on that particular interest rate. I mean, this was a great year for banks because just the opposite was happening for the banks. So next year, I think would be much better for the NBFCs and housing finance NBFCs as well than what this year has been.
Santosh, what about the PSU bank, the mid-tier PSU bank, which had a massive run? Do you think bulk of the positivity now is in the price and valuations look stretched, or do you think based on the fundamental further re-rating can happen in mid-tier PSU banks, so the smaller banks?
See, that particular part of the market, I think I would not buy in my view, because see, the top ranked PSU banks still have some good business. Some of them have really good business models and really good fundamentals. But when I'm looking at the mid-tier ones, I would be worried on a fundamental basis. Yes, there is a technical sort of price catch-up happening because the NPL cycle is turning for better for the entire system. But if I'm an investor, I would try to avoid that particular space.
Okay. What about the HDFC and Kotak variety? HDFC Bank has, from 1300 odd have crossed the 1600 odd level, and we all know the arguments on that one. How do you see that pocket, or even Kotak for that matter, which has been stuck in a kind of a high valuation zone for a very long time? If you just look at the quality of results which are posted last quarter, how does the trajectory look from here?
So I would not like to talk about the individual stocks, but on a broader level, see, this is the entire pack, right? The private sector pack. And in the private sector pack, if you would have looked at a particular set of stocks have done really well for 4 or 5 years because there was no option but to invest there and not to go outside there. But if you look at last 2 years, the fundamentals of the other private sector banks have started catching up with some of the top run. And that's where the underperformance have come in these particular stocks, in my view. Because if you look at fundamentally, nothing wrong has happened across the board in private sector. All of them have done really, really well. So going forward, I think a lot of catch-up has done, and then the market might start start to sort of go away from that particular trade which was happening for 1 or 2 years. So I think private sector is still a space to be in, but within private sector, the churn might again happen in coming couple of years.
Fair point. Okay, let's talk about some other areas of the market. IT is being punished a whole lot, Accenture guidance, and then read-through of HCL Tech commentary. Is it entering a attractive value zone or not yet? Because the argument is that even attrition pressure will come down because of demand moderating a bit. So there is some amount of cushioning, right?
Yeah, so actually this is an interesting area because last year I was looking at certain headlines which was talking about that IT sector is going through its multi-year of great run, and next 10 years are going to be IT years, and suddenly within a year the stocks have fallen, and I could see a lot of headlines talking about that IT is going through a lot of trouble, and maybe not, they may not be this may not be the area to look at. My view is somewhere in between. See, the growth rate at the best case scenario last year for the system on IT side, we are talking about 14-15%. And this year we might be talking about 12-13%, and then I'm talking about 3 to 4 years perspective. Now, this is the broad range we are talking about. But last year, the problem was there was a lot of margin pressure because the entire sort of uh, entire negotiation power went into the hands of the employees, and then that led to sort of higher sort of churn rates within the employment as well as the margin pressure. So I think what you are saying makes a lot of sense in the current year, that actually now with sort of some sort of slowdown, we might see that margin pressure coming off. And I think this is a sector to be in if you are looking at 4 or 5 years. And the valuations are now, for most of the stocks are either at the median or below median on a 5 year basis. So yes, incrementally, this is an interesting sector, and I'm quite positive on this.
That's interesting. Would you also look at two-wheeler stocks which have rural-centric, or even some of the large-cap auto stocks which have a rural portfolio? Because there are early signs coming in that probably rural India is bouncing back, and the prosperity will lead to more sales in those kind of two-wheelers. Would you look at that argument or not yet?
See, means two-wheeler as a space, I have always said that I'm not a big fan of that particular space unless or until someone is a very niche player. Because it's not about rural or urban. It's about sort of penetration, and it's about incremental buying and wherever it comes from. So I think premiumization is a trend happening across, and it's not just about rural or it's not just about urban India. So when we talk about growth, my feeling has always been on the two-wheeler side that this is an area where the volume growth getting into double digits will be really sort of difficult. It might happen for a year or two, but it's very difficult to sustain that sort of volume growth on a longer duration basis. So even if I'm looking at a rural sort of great rural story playing in out for 2 years, 3 years, which I don't ascribe to as of now. But even if you are looking at that, see, I would rather be in the PVs or maybe the smaller CV side of the business, right? The companies which have got better, smaller CV business or better PV businesses which can be sold in rural India. I'd be rather on that side than the sort of two-wheeler side of the business.
Santosh, what is the attractive area of the market in your view? Valuation versus earnings quality which lies ahead?
So, for last 1 year, I was talking about actually financials and banking. Now, actually, my view is still financials, but not banking. Banking, smaller and mid-sized banks is fine, but larger sized banks, I think for them after next couple of quarters, where we may again see some bit of upgrade because the repo may again go up, and there could be still some room left in NIM expansion. But after that, neither NIM will either plateau out or it might fall a little bit just because the deposits have to sort of reprice themselves. And this year growth, my view is that it will be very difficult to sort of get this year growth in the next year as well. So larger banks, which may grow slightly higher than the system, I think for them, next year may not be an upgrade year, or 1 or 2 years may not be an upgrade year. Still a couple of quarters left for that, because next couple of quarters we might still see some bit of upgrades. But the smaller, mid-size or smaller banks, they are because they take a part of the pie, and the call is more about the credit cost, where I think it will remain benign for a couple of years. The mid-tier banks might do much better, and I'm still talking about private sector. I don't ascribe to the PSU call. So that's one part. Second is NBFCs, definitely, because they are late cycle plays. So increasing interest rate cycle is negative for them, and that's what has played out in them for almost 6-7 months. Now, if the interest rates start to plateau out, which I think will happen next couple of quarters, then there could be a case wherein they may grow faster than the banking system, and their NIMs will remain stagnant, which flattish, or might go higher, which is just opposite to what might happen to the banks. So there could be multiple set of upgrades there. So that's another area. And because all the buying was happening in banks, see the entire other part of the financials, which is the insurances, the AMCs, all were sort of ignored. I think next year could see a sort of a comeback of that particular sector also, because the growth rate still is decent in that particular part. And there was some bit of rationalizing happening on insurance, because they were sort of COVID impacted. That was a COVID impacted sector. And AMC was getting impacted because of these sort of yield change, which the sort of stabilization of the yield, normalization of the yield curve, which both has happened and it's already priced in. So those two areas can again see a positive impact next year. So I'm positive on that particular part still.
Right. All right, Santosh, great chatting. Thanks so much for your time this afternoon.
Thank you.
That was Santosh Kumar Singh, Head of Research at Motilal Oswal AMC. Before we take a break,